My name's Samuel Burke. I'm the Chief Content Officer at Find.co, and I just want to thank you guys for being here to discuss RWAs, real world assets. And I want to introduce everybody. We have Mr. Ton from the Tot Foundation, Martin Mather, Head of Growth there. We also have Elias Enriquez from Houdini Swap, the Head of Marketing. We've got Ryan Haczynski, Head of Protocol Partnerships at GlobalStake. And just to my right, we have Gary Chan, who's the head director of business development at Paxos. Let's jump right into it. RWAs, real world assets. It's become a very popular topic in the industry, from tokenizing treasuries to real estate. The promise is quite clear that it's going to be real world value on chain, unlocking access, liquidity, and efficiency. But I want to start with a provocation and say that I heard this all in 2021, of course, with NFTs. And by 2023, we know what happened. 95% of NFT collections had a market cap of effectively zero. So I just want to start in by saying, what's different this time? Is it regulation? Is it infrastructure, distribution? Or are we once again running ahead of what users really want? I'll start with you, Martin.
Thanks very much. Before I start, actually, it's lovely being in America because obviously we're Brits, so this weather is very, very different for. Actually, do we have any Americans here? Any Americans here?
Full of them. They're used to good weather.
What I normally do is I like to give away, like make it a little bit more interactive. So I'm going to find the most American person looking. Actually, there's a guy in a cowboy hat. Can you nudge the guy in the cowboy hat?
He's not American.
Cowboy.
I know who he is.
Go on. There you go. Is that fedora?
Yeah.
Where's that from?
No, not America.
It's not America. Wait, are you America? Yeah. Okay, there we go. There we go. We'll find. Is there actually anyone in America that wants another plush rabbit? Someone offered me $1,000 for one of these. And there's a guy right at the back. Can you jump at the back? I can't see. Shall I?
Where are you from?
Where are you from, actually? US. That's very general. That sounds very okay. Right. See if we can get him. Ready?
Winner.
There we go. Yeah, and look, I think definitely RWAs is changed a lot since, like the last few years. I'm assuming everyone's on Telegram. Is everyone on Telegram? Is there anyone not on Telegram here? Yeah, there we go. Is anyone actually listening? Because this is another, But look, I don't know if you know, the best thing about Telegram, I'm for Ton, you can send in messages crypto. You can send USDT, you can send Ton. But you can also send some of these real assets. I'm assuming everyone's heard of Tether Gold. Anyone know Tether Gold? Obviously, that's an RWA. I'm assuming we're going to do that. You can send that. So in the messages, you can send someone RWA, just like that. So look, the infrastructure of getting this, and we've seen stablecoins exploding. We've seen a lot of the infrastructure being supported. We're there to do it. However, I definitely think there's a lot of RWAs that probably aren't needed, or we have a huge amount of supply rather than demand of it. I get asked weekly, can I tokenize uranium? I've got like 10 billion of uranium. Can I tokenize that? Got no buyers. So there's going to be this middle ground, and that's going to be probably my conclusion as well going forward there.
Elias, the same thing. I would ask you, are we ahead of where people really need to be? I mean, maybe we'll get there someday, but what is the market demand really? And are there other verticals like uranium that you say, this just isn't uranium's moment?
No, it's I don't think it is uranium's moment. And the thing is, tokenization, like we've solved the custody, the transactional part of that with these RWAs, but when it comes to liquidity and actually having buyers, that's not the tokenized problem. That's like the market depth problem, right? So it's bringing people in that actually want to buy and trade those assets. That's maybe where we're lacking, and there's maybe a few barriers, and it's probably in the discussion. We can talk about it more of what is holding people back from coming in and providing that depth. But yeah, you don't tokenize something and immediately have someone just waiting in line to buy it.
But from a liquidity perspective, do you think that RWAs actually behave like assets that users want to trade, or there's still too much friction, too friction heavy?
I mean, for when it comes to friction and liquidity, it's, I heard someone on the previous panel talking about the fragmentation of all the different chains. You can have RWAs on Ton, But if you've got stuff on Solana, on Ethereum, treasuries, and you want to do some there's too much fragmentation and too much friction maybe on that area. And then the other side too is really the privacy side of it, right? So, how are we going to be able to trade these things and have liquid private rails as I think that's the issue that we need to solve, is bringing more people on to be that market depth for people to actually want to trade these assets.
And Ryan, for you specifically, because you're coming from GlobalStake, do you think that RWAs fit naturally into yield-driven ecosystems like staking, or do they require completely different user behavior?
I mean, I think they do, but fundamentally, I want to step back to the bigger question, because all of it has changed, right? I mean, when you think about regulation, everything that's happening from the Genius Act, the clarity we're about to get markup, get that across the line. And we're talking about massive institutions who are moving into the space, right? I mean, when BlackRock did BUIDL last year and you had, them bringing billions on chain, I think we're solving some liquidity issues. But when we talk about users, who are we talking about? Are we talking about these TradFi giants that are moving into the space that are able to access these tokenized products? Absolutely. How well it fits into a staking thing is it probably isn't as relevant, because these are not, say, permissionless blockchains that are offering emissions in order to secure the chain itself. But in the broader yield, yes, I think it absolutely is, because we're seeing on the institutional side at GlobalStake a lot of demand for yield in general for assets. There's a lot of family offices and hedge funds that are coming in, even if they're just starting off with something as basic as, we have an allocation of Bitcoin, how do we earn yield on that? So I think RWAs are a huge part of that. When you just think about the ability for stablecoins to earn just the treasury, I mean, now you get into the big debate of whether or not there is the risk, because you're not getting the same kind of rate that you could in the risk-free rate. Yeah. So we're now in this tumultuous period, I think, because of the DeFi hacks that we talked about on the last panel as well.
I'll get to you in 1 second, Gary. I just wanted to drill down on this. It's really important. I mean, when you think back to like the height of DeFi in the summer of 2020, 2021, you had, people were conditioned to extraordinary yields, protocols offering hundreds of percents. So, I mean, now today it's like, 3 to 4% on e-staking yields. But I'm just wondering, does that really skew people's minds still in the market? What are you seeing? I assume less with these institutional investors, the family offices they were talking about.
So I'm part degen, part I wear both, I'm a hoodie and a suit, right?
That's why I'm asking you.
And you bring a tear to my eye, because I think about those times where I got rugged on 10,000 APY farms going from one to the next in DeFi summer. But I think that when it comes to the slow, steady yield, I mean, there's a sense in which even just staking Ether is like a bond, right? They're going to earn a steady 3%, stuff like that. So again, we have to define user and drill down on that. If you're talking about your average degen, they have absolutely skewed their, money perception in general, but APYs, I mean, if it's not double digits, I'm not getting out of bed. I'm not even going to click my wallet or anything like that. So when you talk about the original users, yes, it's not going to move the needle. But I think if you offer even something like 10%, I mean, a lot of institutional players are very, very interested in that.
And does that mean you just have to maintain these two different market segments, or are you drilling down?
I think in GlobalStake, we're more focused on institutional, right? But this is like me personally versus just like how the company operates.
And just one more thing there. So you're saying we're in a fundamentally different place at the end of the day from where NFTs 100%. Genius Act, like you referenced.
We have the initial pieces in place. We need clarity across the line, though, for sure.
And Gary Chan from Paxos, same question to you. Are we over the whole NFT? We've been burned and the scabs have come off now? We're okay?
Yeah, I mean, I think so. I think that, everybody wanted to tokenize everything, back a few years ago. And I think the focus now is a lot more on sort of like, where is their value, right? And so tokenizing dollars, obviously, right, through stable coins, tokenizing other real world assets like commodities, like gold, right? You mentioned, Tether Gold, and, we have our Paxos Gold product there as well. Gold has been on a hot run over the last 12 or 18 months. And so,
I've heard a little.
Yeah. So I definitely think that it's there. I just think that there's more focus now, right? In terms of like what's real, what's possible, and sort of like what is in demand, as the other panelists has mentioned.
And from a Paxos point of view, or from your personal point of view, so you say very clearly the demand is there. How much more clarity do we need, though, on regulatory clarity and trust frameworks?
I think definitely a lot more. I think the unlock for institutional is through regulatory clarity, right? And so I think regulatory clarity is an enabler here. We've seen that with sort of like institutional adoption of stablecoins. With folks like TradFi players able to enter the space now through more regulatory clarity, and that starts with things like stable coins, right? For whether it's, moving value or payments or what have you. And then I think that there's demand for, the sort of like, crypto trading and things like that as well. But you're starting to see folks like, Charles Schwab announced Schwab Crypto, right? It's a big announcement for sort of like the TradFi space, of one of the largest broker dealers, in the world entering that space.
And going back to Ton, for example, I mean, you guys have an incredible story. Telegram has over 900 million monthly active users. But I just want to share a stat with you. 2023 EY survey of 250 institutional investors found that only 13% had any exposure to tokenized assets at all. I'm sure that number is up since 2023, but not hugely. These are sort of sophisticated players, so I'm curious about the gap between the reach that you guys have and the demand for these real-world assets.
I'd question, why do people need it? So realistically, why is Tether Gold, why is Paxos Gold doing so well? Because the prices of gold's going shooting up, okay? So I want to get involved. And why don't I do that in the traditional markets? How could I buy gold? Honestly, how can I go out there and get gold, get exposure to that? I see it pumping up this commodity. I've got no way. I'm pretty sure it's a very tricky way for an average person, for our Fedora man to go out and buy some gold. How could he do that? Aside from actually physically buying gold in the street, it's going to be tricky. So the really cool thing about what we're doing with RWAs is we're unlocking a lot of these friction, a lot of these barriers. We've got like 24-hour trading, traditional markets close, as we know, like throughout the weekend. So we just see gold, oil prices. We have a load of interesting news over the weekend. We don't know what's going to happen to the oil price because of the markets. This is the really cool thing. You start giving people access to a lot of these tools. It's not going to be an overnight thing. It's not going to be a 1, 2, 3 year thing. But once you start having access and wanting it, it's going to start really getting bigger reach. And as I said, look, gold at the moment, gold and silver, people want exposure to that. You start doing other commodities. That's just how it's all going to happen.
Elias, I have some very specific stats here because I want to be skeptical because I've been burned before. So I want to show you kind of interesting contrast. The daily trading volume at Uniswap, decentralized exchange, regularly exceeds $1 billion. Meanwhile, the entire on-chain real-world asset market, excluding stablecoins, caveat, is around $8 to $10 billion total outstanding, with daily secondary market activity that's a fraction of that. So liquidity in RWAs isn't like DeFi liquidity. I think we all know that. But many tokenized assets have lockup periods, accredited investor gates, redemption windows. So when we talk about liquidity as a selling point, I want to understand liquidity. For whom and under what conditions?
I mean, like, for the tokenizing something doesn't really solve liquidity. I don't know if I'm misunderstanding the question there, but like you tokenize something, it's not like you now have all this liquidity waiting to take a hold of it or to buy it, to trade that asset. So they function very different from most other trading pairs on these decentralized exchanges, right? So they're not going to function the same way. But yeah, I don't know if I'm misunderstanding.
I think
the question here. Is it tokenizing equals liquidity or?
No, I mean, I think fundamentally is different liquidity for different spaces.
Yeah.
At the end of the day.
Yeah, and liquidity can be very fragmented too right now, right? Like we can have liquidity on different chains. On Uniswap, they have different pools on different chains as well. So how do we connect those rails? Well, we have partners like ourselves, like ChangeNOW, that help us do exactly that. You have assets or liquidity on Ton. You want to get some real world assets that are maybe on Ethereum. You need some interoperable rails to connect all that liquidity together, because right now it's too fragmented. And the reality too is most of that volume that's just being traded around is with most of the people that are at the events like today. Like we need to start bringing in new people, make the rails to come back into or come into on-chain easier so that we can get more liquidity and more people trading, more people wanting to get a hold of tokenized assets to have a deeper market in that area.
Did you want to add something there, Ryan?
I did.
Yeah, I saw,
because
I saw you, I saw you pondering.
the two previous answers. So I think one of the things we're missing is on the institutional side, these are different, more sophisticated operators. So when you talk about these particular metrics, there's $8 billion of RWAs on chain versus $1 billion is being exchanged on Uniswap, there's a fraction of that 8 billion moving hands. I don't think that they're necessarily trying to run arbitrage bots. They're not the typical crypto degen who's been in this space for a long time. So when you think about Martin's example, going and buying the gold, it's so much easier to have Paxos gold, for instance, put it in a lending protocol. You now collateralize that. You gain capital efficiency. Maybe we're seeing the liquidity in ways that's not really transparent on chain because it's not an immediate swap. Now I can take those stablecoins and I can deploy them in a more meaningful way. Or when you think about what Elias is saying, same thing too. Like if you have that fragmentation, again, you might just not be seeing it because there's certain venues, a lot of it may be happening on ETH, where they are using these RWAs as collateral, that then they can take the stablecoin loans and go borrow things. And because there is sort of that risk right now where everybody's scared, the stablecoin rates are actually low. So if you can find a way that's to earn yield meaningfully, maybe it doesn't have to be natively on the RWA itself, but using that as a collateral and then taking those stablecoins and putting them to work somewhere else, they may have a more, especially when you talk about these large institutions, they may have another arm that's doing, delta neutral basis trading and then taking the funding rate and earning that. And, so there's, I think, sophisticated things that are happening in a blend of on and off chain that sometimes the data doesn't necessarily reveal.
Surely, Ryan, the way that RWAs are at the moment, institutionals won't want to get involved just because of the privacy as well. Because
I think there is that. I mean, we run Canton, for instance. Yeah. So we run both our own node and as node as an operator, as a service. And so we do see a lot of these large institutional players coming to Canton specifically for that reason, because they know they have privacy if they're moving block trades or anything else like that, or RWAs through the nodes. Because the way Canton works is you have just node to node privacy, and the consensus isn't met across all the nodes on the chain. So yeah, I think you're going to see a continuing development along both those lines where there's going to be privacy seeking. But I think the ones that are just happy to have large capital allocations just sitting on chain and earning a small yield in treasuries, for instance, or credit products, they're just going to do that for now.
And Ryan, you actually mentioned Bust, but I believe, but this is a question for you, Gary. So BlackRock tokenized the money market fund, and we went from 0 to over 500 million in assets under management within weeks of launch in 2024. I mean, this is hugely impressive stuff. Mm-hmm. But Paxos had a brush in 2023 when NYDFS ordered Paxos to stop issuing Bust, the stablecoin used with Bitcoin. So, and that was pretty much overnight. So, I mean, it really raises a question about regulation. If it's always the enabler we're describing here, sometimes the hand pulls the rug.
Yeah, and I imagine for Buzz, you're talking about BUSD, the Binance. Yeah. So, I think that there are a couple elements to that, right? Like one, BUSD was, a Binance white label stablecoin that Paxos issued. Yep. And I think at its peak, it was at $23 billion, $25 billion. And, I think the DFS at that time and just sort of US regulators in general during that time were not so friendly towards crypto companies. And so I think
we're in a very different environment now.
Very different environment. I think there was more behind that than just saying, hey, look, Paxos, you can't issue a stable coin, right? But I think our decision to really kind of separate ourselves in that instance, but still be able to redeem, 16, 17, $20 billion within a matter of months is sort of a testament to not just how regulators act from an enforcement perspective, but how we've really built our infrastructure from a regulated perspective to be able to do the redemptions at scale and really not have any issues. I think $16 billion or $20 billion, that's unprecedented and hasn't been done. And so, that was, while that was a tough moment, I think for the industry, for Binance, for Paxos, and for BUSD, it really showed sort of the resiliency that we've built through kind of building a regulated offering.
And do you still feel fear? I don't know if fear is not the right word. Are there people who still hesitant because of that, or is it just pesky journalists like me still focused on that?
No, I don't think so. I mean, it's definitely a significant event, right? In the history of like stablecoins and regulation. I think that there's a lot of learnings, right?
That was going to be the word I used. What's the learning there?
And so since I think like we've definitely become more robust in kind of like knowing what our partners are doing, with their stable coins, whether it's sort of officially like Paxos issued version that is on chain, or if there's other activities that are happening sort of like on top of those Paxos issued tokens. I think also we always strive from a regulatory perspective to improve and to work closely with our regulators. And so since that happened in 2023, we've moved from a New York DFS trust to an OCC trust charter. So we're federally regulated now, working very closely with the OCC. We still issue PYUSD for PayPal, which is over $4 billion now. Paxos Gold is over I think $2.5 billion in issuance, and we've issued I think over $180 billion of tokenized assets. And so it's not going anywhere, right? I think people are constantly coming and talking to us about like, hey, how do we issue our own stablecoin, or how do we join the network for Global Dollar Network and USDG, our newest stablecoin that we're issuing. And so there's definitely still interest there. I think people may think twice about white labeling a stablecoin because there's a lot of time and effort and resources and money that goes behind that, but there's still definitely interest.
And I mean, let's just call it what it is, or kind of in this Trump era.
Sure.
And are there people who, I mean, what's the thinking out there? People think, oh, it may only last during this administration, or is there more of a sense now it's here and it'll be more like, I would say, traditional times in the USA? One administration does something that tends to stick.
Yeah, I mean, I think that the doors have been opened, right? A lot of institutional adoption right now. A lot of traditional financial institutions are starting to get in the game, and so I think it's going to be harder to put the toothpaste back in the tube at this point.
Yeah.
I think it's just progress that we've made in the industry. I think there's been a lot of big wins for the industry, and I think the regulation and regulatory clarity has helped, and it will continue to help. So I think like the further we go down the line of this, and then the more adoption that there is, it's going to be hard to close that door again.
And I want to ask all of you guys this, but I'll just do one more with you on this, Gary. What makes a user actually choose an RWA product over the traditional alternative? Paperwork?
Well, no, I think we talked a little bit about this, but part of it is like, hey, how do I get gold, right? Like, how do I know that the gold I'm buying is good, right? Like whether it's XAUT or PaxG, it's like, hey, you can actually tie an ounce of Pax gold or 1 Pax gold to a serial number that's on a bar of gold that's held in a London vault, right? Like that's the type of thing that people are like, oh, that's cool. So once I have enough gold, I can actually redeem a physical bar. Cool. I don't know what I'm getting if I'm going to like a store, like any random store to buy any gold. I may not be sophisticated enough to go and trade gold futures, right? And then I don't even know really what that gets me. It's not actual physical gold, right? And so like, I think there's some element of, hey, look, I actually have ownership of this thing, right? I'm buying a tokenized real world asset. And even though I might not be able to redeem like a quarter of a bar of gold, right? Like I still know that is actually sitting in a vault somewhere in London. And if you own Pax Gold, you can actually go and get a tour of the London Vault.
I think for retail, gold is the easiest entry point in, honestly, because we're always, like going back 20, 30, 40 years, gold standard, everyone knows 100%. back gold. We even call Bitcoin digital gold. You start having those touch points for retail in particular. Right. That's a great way of RWA. And the reason it's great is because you're cutting all the friction, the costs, and you're making it easier.
Yeah. And you're seeing a lot of markets that like historically have put a lot of value on gold, right? Like Turkey, for example, people are like hiding gold like under their mattresses and stuff like that. Now they're like, hey, look, like I can actually, one, like certify the quality of the gold I have, right? And then two, I don't have to worry about like custody of gold. Like custody in this case is like under their mattress, but like, if I'm actually holding Pax Gold or XAUT, I can actually say, hey, look, like I have the custody of this in either my custodial wallet or non-custodial wallet, or however I want to hold that.
And Ryan, same question for you. The RWA over the traditional alternative.
I think it's a couple things. One, confidence, ease of use, and just to your point, paperwork. And I'll share a quick story. Confidence, because early on I want to commend Gary and Paxos. They were the first regulated stablecoin through the state of New York, which is notoriously the most difficult place to do anything in crypto. And that's why I was holding their stablecoins back in 2020, because just knowing that they had that regulated product. So the confidence in the RWA, I think, is huge. The ease of use, like I said earlier, the ability to just go and deploy that capital on chain and get something instantly, which brings me to the paperwork part, because my wife and I did the most degen thing possible in 2020 when the COVID crash. We took 50K out of the house in equity, and we basically then bought a bunch of Bitcoin and some crypto, did very, very well on all that. But the paperwork was insane.
You put your money where your mouth is, not where your house is.
Yeah, and the paperwork was insane insofar as like all the applications, having to sit down with a banker, everything else like that. Today, I can take Bitcoin or any RWA, go to a lending protocol, deposit, take out whatever loan to value I feel comfortable risk, and I have done this in seconds, where something took literally months to get access to capital. So I think RWAs, especially as more retail people get access to them through gold and other means, it just changes the game.
Yeah.
Similar question for you there. The RWAs over the traditional alternative.
I mean, for better or worse, I think all of mankind is going towards whatever's more convenient, right? until eventually we're just riding around on floating Wally chairs, and having food shoved in our mouth. So whatever is more convenient, people are just going to go ahead and do that. And that's the reason now you go and you take your tokenized assets and you get your loan that quickly. You're going to do it that way because now you don't have to sit for months. It's just way more convenient. So if the convenience is there, people are going to use it, and that's what's going to drive people towards it.
Martin, what's the biggest risk here? I mean, we've talked a lot about the positives. I think it makes sense to a lot of people in this room. What are some of the big risks here? What parts of this? I don't want to say why might RWAs fail. I think that's a stupid question. But what parts of it are the toughest?
I'd like to know, honestly, because we've seen it a little bit. What happens if some of these RWAs are hacked? And we've seen some protocols being hacked and it's completely destroyed it. If, I'm not going to say anything major, but then you start buying stuff. Like, let's just say we tokenize our chap's fedora there. I've noticed it's a fedora over that. He loses the fedora. What happens with that? You tokenize the art. All of this stuff. There's a lot of ifs and buts. Again, so I think that's a lot. And again, it's just oversaturation. But we've got two audiences. We've got retail and we've got institutions. Institutions should be able to use this as the next step of getting liquidity, cutting down costs, cutting down the friction. I worked in banking for 20 years, okay? It's going to take a long time for a lot of these banks to integrate. This isn't just it's overnight thing. I don't know, most people know most of the banks still have software that's much older than me, probably from the 60s and 70s, the legacy stuff.
Anytime somebody says, like, what if it gets hacked or quantum computing is a existential threat to crypto, I think, well, is it an existential threat to my bank account as well? If not more so, since some of that banking software looks like Windows 95.
No, I'm not joking. If you ever see any of those 80s films at all, when they all some of that banking software still looks like it.
COBOL mainframes, right?
COBOL.
So I don't know how you're going to fit a lot of this in for the traditional banks. Obviously, there's other ways and stuff like that. And, but again, these are some of the risks that, we've got a great ideology, but there's a lot more friction coming forward. And, you actually need first movers, because one thing that people don't realize is if you're in a bank and you want to do the RWAs and you're head of digital, you're head of this, it's a big risk to be that first player, because if you do really well, you get a tap on the back and maybe a bonus. If you mess it up,
you're out.
You're out.
Yeah.
So, yeah.
Elias, Ryan, Gary, any thoughts on that?
I think it's going to change with maturation in the industry. Like, there's Realm is over here, which is underwriter. So what we're seeing is you're going to see more insurance products for these kinds of things. I was in another panel where there was a conversation around our DeFi vaults, the new ETF rather, where people are going to just put those assets in those vaults and have them work, because increasingly, as Elias was saying, everything is going to come on chain, right? This is all just going to become seamless, and it's just a matter of time. Although the banks will probably still be last, as Martin said.
Yeah.
You can tell I like to be skeptical. I've been burned a couple of times, but I want to finish on a positive note about really what wins. So if I could just go through with each of you, what's the single biggest unlock needed right now? Not right now, needed in general for RWA adoption, Gary?
I'll go back to, regulatory. I think regulatory clarity. I think sort of like non-fragmentation across jurisdictions, right? So I think one thing that's tough right now is like, the US, the EU, like all these different countries have different ways of regulation, different rules. And so it's just like, it's hard to navigate, right? You have a single token, right? That could be accepted in the U.S., but in the Europe, there's different requirements around it, right? When you have a dollar, the same is not true, right? And so I think just everybody getting on board, understanding that, hey, look, like if we're actually going to have real world assets succeed, right? Whether it's dollars, gold, real estate, whatever it is, right? Tokenized deposits. There's got to be regulatory clarity. There's got to be sort of like a meeting of the minds from a regulatory perspective as well, so that these institutional, funds and flows can actually work.
Biggest unlock, Ryan, beside regulation?
Besides regulation, you got me there. Because I was going to say the Clarity Act. I mean, it absolutely has to pass because to your point earlier, we've been in this cycle of executive orders and people just coming in and one administration changing to the next. And the industry has been caught in the middle. And I think if we get the Clarity Act passed, that is going to not only cement things in legislation, which would be very difficult to change, but I think there is honestly a wall of institutional money that is pent up waiting for this one piece of legislation to go through. And I think once that does, it will be a complete game changer because all of the other things, it'll be just a sea change where, rising tide lifts all boats. And better infrastructure, better guarantees, better, more mature products, whether it's insurance and everything else. So it's going to change the industry.
Elias, biggest unlock?
With crypto and all this movement that we see going on right now, RWAs, their borders are becoming more and more like blurred, right? Everyone's becoming so connected through social media, through crypto, being able to send money across chains. But we're seeing still we're like creating our own borders within all these different chains. And then we're creating like unnecessary friction. So a huge unlock would just be having all of that seamless so that all this fragmented liquidity pools and on all these different chains and just having it all connected and in a private way so that we can onboard your grandma into crypto. She can get in, she can start buying RWAs, but she's not like completely doxing, all the stuff that she's done in the past and not have it connected to everyone. And, when she's sending you your Sunday, Domingo, your allowance on chain, it's not shared to everyone in the world. So privacy and interoperability, I think, would be two massive unlocks for
Martin,
Just don't call them RWAs. So out there. There we go.
in one more closing thought goes to you though, Martin. In 2 to 3 years, what do you think we will realize we fundamentally misunderstood about RWAs?
That it's as complicated as it's made out to be.
Okay.
There we go.
We can't simplify it nearly as much as we thought.
Simplify it. There we go.
Martin Masser, head of growth for the Ton Foundation. Elias Enriquez, head of marketing at Houdini Swap. Ryan, head of product protocol partnerships at GlobalStake. And Gary Chan, director of business development at Paxos. Thanks so much.
Thank you for
joining us.
moderating.
Thank
Thank
you.
you very
Yeah.
much.